Are you looking to get ready, be prepared, and transform your financial future? Then you've come to the right place. This is the Get Ready Money podcast with Tony Stewart, where Tony has insightful conversations with financial experts who are changing the way we think about money. Catch up on the latest financial trends and hear practical advice from Tony and his expert guests so you can build healthy habits that work. Be empowered with tips for implementing small changes that can have a big impact on your financial future. So sit back and get ready to hear from today's guest.
Welcome to the Get Ready Money podcast, changing the way we think about money. I'm pleased to be joined today by Steven Zeiger. Steven is the Managing Director at KB Financial Services and Managing Director at Veralytic. In this episode, we'll be discussing Steven's insights on how we change the way we think about money and life insurance policy analysis, a subject that's near and dear to my own heart. Steven, welcome to the Get Ready Money podcast. Thanks for joining us today.
Thank you, and I hope I'm ready.
Well, let's do this. So tell us a bit about yourself. What is your origin story?
My origin story, well, I was always an entrepreneur, right? I had a car waxing business and I was making, a couple $100 an hour when my friends were making minimum wage. And I decided I wanted to go into the insurance business because I like working with people. I like helping people. I like finances. And then I discovered that the reputation was really a used car salesperson. And I saw the RIA industry and I said, wait a minute, how can I make my business like their business? And over time, it evolved to using the exact same tools that RIAs use, but using them to evaluate life insurance as opposed to investments. So that's the initial sort of where I'm from background, right?
Yeah, well, that's similar to, what led me to be a fee-based insurance consultant. The same thing is just that feeling like it wasn't quite the same, and to try to get on the same side as the client, to be a true advisor. Not to say that there's not some great life insurance agents out there who do a great job for the clients, but it's a different relationship when you're an agent. I mean, it's inherent in the name agent.
Yeah, I totally agree with you. I think that if you and I polled 3 people or 1,000 people or 100,000 people, they'd all say the same thing about their life insurance experience. They would say there was lots of sales pressure. They would say that there was a frustration that there didn't seem to be clarity or transparency. There seemed to be lots of conflicts of interest among the brokers. And I think there's this utter frustration that they're given an 80-page illustration with 70 rows of numbers and 10 columns, and they're supposed to compare that one to 5 or 6 others. And that leads everyone to not having a good outcome because there's really not a process to decide, well, which one is actually better and why. And that's really what we've made our practice, all about.
Yeah, no, that's fantastic. And you bring that up. It was just actually a conversation I had with a friend of mine who's also an insurance consultant. And we were talking about that, about these long illustrations and, why can't there be a one-page summary, like they try to do with mutual fund summaries, prospectuses, which are also incredibly long. Nobody, I think, reads those except for the attorneys. Same way. You and I are probably one of the, there's probably 100 people in the US who read a complete life insurance illustration and can actually say something about it.
Right. Yeah, it's, you see it with, I'll read the illustration, but when I get a new furnace, I don't read the 30-page manual. And when I get a new electron, I don't read that either. And I think most people don't. But you did mention something sort of interesting, and that is that one-page summary, right? So, not here to advertise, and just so you know, when people want research from us, we don't charge for the research, right? I'm not here to sell anyone a product. I'm here to change the life insurance world and make it client's best interest world based on a research model or an independent consultant model, just like you have in the RIA business, right? And, you and I speak the same language, but imagine that you and I are looking at an illustration and we just took the present value of the premium stream and the present value of the cash values and the present value of the death benefit. And then we turn those 80 rows of numbers into one number for each, one number for the premium, one for the cash value, one for the death benefit. And that might make it easier to compare those numbers to some other policy, right? Because now we've taken, instead of 70 rows of numbers and 10 columns, now we've turned it into like an embryonic benchmark, right? Even though the benchmark is probably wrong because we didn't take the present value at a certain discount rate, but I think you and I can agree that that's an easier start. And then from there, an actuary can help us build something where we can turn that 80-page illustration into a 1 or 2 page, report, like a Morningstar report. And then that enables the consumer or their advisors to make a decision that leads to a better outcome, because we can clearly see one company's premiums are substantially higher and one company's costs are substantially higher and right? And I think that's the framework that we use in our business, right? Independent research, and the independent research benchmarks the premiums, the costs, the cash values, the death benefits, the returns, based on everything else in the marketplace. It's not perfect, but it's 1,000 times better than trying to compare that 80-page illustration yourself when you don't have those tools.
Yeah, well, that's a great start. It made me think is when you need an actuary to help you make sense and explain something to you, is it's complicated.
Right, exactly. And then the funny thing is, somewhere in that 80-page illustration is the attestation of a client that they understand the 80-page illustration, right? So that makes the whole thing even more laughable, right? You're not given the data, the correct data to make the decision, and then you're required to sign that you do understand, right? That's just no way.
Yeah, it's just like signing the terms and conditions for any of these web services, software applications. It's like, I don't understand a lot of it, but yet you and I are using Zoom. So, I agreed to something, and hopefully it's not horrible. So, let's talk about life insurance being confusing, because that's also something you hear. And, we're talking about the 80-page illustration, but it goes beyond that. When you look at the products, why is life insurance confusing? Why are there so many like moving parts and just all these things when you think the concept is simple? Somebody passes away, the company pays a premium, they should collect a death benefit for it. But did it get so confusing, and why is it so confusing?
Well, I think that it could be straightforward. Here's your premium, here's your cash value, here's your death benefit. But I think one of the problems is that the insurance companies have sort of figured out how are the agents comparing the policies, right? They're putting, or how are the agents comparing the illustrations? They're putting them into some Excel spreadsheet format, and the insurance companies have figured out, hey, wait a minute, how can we win that Excel beauty pageant, right? So I think life insurance is math, right? You can put a life insurance policy into an Excel spreadsheet. Here's the premium. Here are the costs that are being subtracted. Here are the earnings that are being added. Here's what you're left over with. But now you get into financial cookery, and the financial cookery to win that beauty contest. I think that's really what makes it confusing and misleading. Do you agree with that?
Oh, I agree 100%. It's the addition of all these riders and then terms. And I don't know if you've run into this, but I've analyzed policies too, where you essentially go in a circle trying to define certain things. It'll say refer to page X for this table, and then you refer there, and it's like, okay, well, now you need to go here to add in this component, and then you get either back where you started, or it's just, and so it's like, I'm not even sure the companies know what they're putting into these policies sometimes.
Right. And I'm going to share my screen in a second. I know we didn't talk about that, but these are
it's normally we don't do screen sharing on the
no,
podcast.
All right. So I'm going to read you 4 numbers on an illustration, right? And I think this will be really interesting for the viewers. So picture this: on the upper right of this illustration that I'm looking at on my screen, the rate of return is 5%. And then in the illustration it shows how much is the premium, how much is the cash value, how much is the death benefit. And the premium here is $12,000 a year. And in the 11th year, the cash value is $116,000. So you and I would think that we're going to multiply $116,000 by 5%. And that's how much somewhere the cash value should be going up, right? So now what we do is we order a special report from the insurance company that's not part of the illustration. And it shows what's the premium that is on the front page, what's the premium load, what's the admin charge, what's the non-guaranteed coverage charge, what's the non-guaranteed cost of insurance, et cetera. And then how much interest is being credited. And at the upper right of it, it says the 5% number again. And you and and I'm looking at the cash value being $116,000. And the insurance company's crediting $16,556. We can do quick math and say, wait a minute, that's not 5%, right? So what the insurance company's doing is they're cooking the books, right? So in order for that illustration to work at 5%, the crediting rate needs to be 14%. And that's one of the games that are being played by the insurance company. And if we're only looking at the illustration, we can't find that game, because when the insurance company shows its cash value, the cash value it's a commingling of cost and performance, right? So you don't know, are they earning 20 and only crediting you 5? Are they earning 5.5 and crediting you with 5? There's no way of knowing unless you look at this additional information that's not part of the illustration. And I think that's when people see that, that's when their eyes open and like, wait a minute, what's going on here? And that usually gets people they want to know more. They get addicted to, wait a minute, I want to make sure that I'm not the one who owns that policy that requires a 14% rate of return, even though the crediting rate is 5. Or a CFP is saying to themselves, oh my God, I wonder which one of my clients have this future nightmare.
Yeah, well, that leads into my next question is, why should advisors analyze or work with somebody to analyze their clients' life insurance policies? I mean, should financial planners leave this alone? Is this part of something they should be doing? I think life insurance is clearly part of a CFP's obligations.
Right, and it's in there, it's not the CFP creed. I forgot the name of the document, but CFPs are required to disclose all of the costs that their clients are incurring in any transaction. And for life insurance, those costs are the policy expense, the premium load, the cost of insurance charge, et cetera. But I think you just mentioned something really, really interesting. And that is, what's a CFP? What's the insurance advisor supposed to do? And I'm going to bifurcate the insurance world, into 2 pieces. So piece number 1 is, I'm the insurance agent. I can go subscribe to independent research like, Morningstar, like Veralytic, like Value Line, like Ethical Edge. And other agents can do that also. And then there's a whole other group of insurance advisors, and their compliance departments won't let them use independent research because their goal is to either sell one particular company or a short list of core companies. And I think the only way around that is if they can't get this research approved, they should use a fee-only consultant to help them arrive at the better outcome for their clients and take away all the conflicts. So I think we just uncovered an opportunity for the fee-only people in addition to the research-based people, right? I'll tell you a quick example. So I was presenting at the New York City Estate Planning Council, and an individual from a big national bank, its initials are WF. He said to me, "I love your model. Can you help me out with a case? It's a $2 million premium case. I want the client to have the best outcome. I'd love to use your research, but I don't know how to use it yet." So he sent me some information. I ran all the research for him, and I said to him, "These are the 6 best companies." And he said, "Oh, great, phenomenal. And these are the best because their ratings are the highest, their costs are the lowest, their premiums are lower, their cash value is highest. They've got the best historical rate of return." He said, "Thank you. This is great. I love it." He calls back a couple hours later and he goes, "I'm not allowed to sell those companies you're recommending. I have to choose from the list of some other 5 where my company gets the biggest bonus from." So that's really what's happening in the insurance businesses. Obviously, some people don't want to use independent research for whatever reason, and some people can't use it. The only way they can use it is to quit their job, and that's a tough jump. So I think that's one of the reasons why the insurance world, isn't changing. Right? There are definitely barriers that keep this industry from getting better.
Yeah, without a doubt. I mean, we could go into the compensation system and all the other challenges, but it's clear the industry is having issues. I mean, the majority of insurance agents are out of business in the first 5 years. The majority of permanent life insurance policies lapse in the first few years. I mean, the list goes on and on. But let's get back to the advisors for a second. So, let's say you're a CFP, you're listening to the show. I do have a lot of financial planners who tune into the show. Where should they get started with analyzing a life insurance policy?
I think that they should dip their toe in the pool by calling a fee-only individual and perhaps call you, right? Or they can dip their toe in the pool and call me. We have different, sort of models, right? A fee-only advisor charges a fee and is not involved in the transaction. In my model, I use, patented research that I can't influence. And sometimes people come to me and they say, "Hey, can you do the transaction?" And some people think, "Hey, there's a conflict." But I say, "Hey, I can't influence the research. There's no conflict. But if you want to call a fee-only person, here's Tony's telephone number. Here's some other fee-only people," right? So whatever the client wants, they can use whatever model, but they should start, right? That's I think the first thing that a CFP financial planner should do is to start the new process of dipping their toe in the pool, calling a fee-only person or calling a research-based person, and see which one they find helpful for their particular practice, right?
Yeah. So, let's say for the average CFP, they're not ready to hire somebody. Are there any tactical steps they can take?
So what we do in our model is if someone is a fiduciary, an attorney, accountant, family office, trust company, asset manager, CFP, they can send us either a proposed or in-force illustration. They can redact the person's name and the broker's name that's typically on the illustration. We then take that information, and depending upon the policy type, we submit that information to the 4 independent providers of life insurance research. And 2 days later, as long as there's not a hurricane, we've got the research in our hands. We present it to the CFP. We teach them. They learn, right? It's educational in nature. And then they slowly explore how, just like the first time you looked at a Morningstar report. So anyway, I don't understand this part. It's the same thing here. It's like peeling the onion to something that's always been a black box. And now you get to see, oh, here's how the cost of insurance charts work. Here's what it actually is. Here's what, and you get to compare on the 5 different, areas of suitability in a life insurance contract. What are the claims paying ratings from Moody's, Standard & Poor's? Duff and Phelps information that's available, in several places. B, what is the premium for this policy and how does it compare to the premiums of all other general account products or all other separate account products? What are the internal costs that the person's incurring? Policy expense, premium load, cost of insurance charge, cash value-based wrap fee, compared to the cost of all others. And now you see, okay, I've got the best ratings. That's great, but I'm overpaying by 30%. Is that a fair balance? Or if I went down 1% on the Comdex score and saved 22%, would that be worth it for me? Okay, it might be, it might not be. But again, they have all of the information available on internal costs, ratings, premiums, cash values, and historical return of the underlying assets. And then for certain policies, they can actually run a Monte Carlo simulation on the insurance illustration, just like they can run a Monte Carlo simulation on all of the other clients' assets, right? So those are the tools that we can utilize for someone to see, A, are they overpaying? Are they getting good performance? Or is there sequence of return risk that they haven't been able to decipher before? Does that make sense?
Yeah, that makes sense. I was thinking, well, one, there's two takeaways. One is like anything is research and understanding the product is a big key and getting the right resources. But the other thing is that, there's a complexity to these products that it sounds like where they can't, what I was hoping is if there were any steps that you could share that an advisor could do on their own before they dip into the research, just to do a first run at it.
Yeah, so I think it's fun to, but it's interesting. It's interesting to take a life insurance illustration and put it into Microsoft Excel, right? So you have a premium column, a death benefit column, a cash value column, and then start playing around and seeing, well, how fast is the cash actually growing compared to the rate of return in the illustration? Or trying to figure out how much, if I have $100,000 and my crediting rate is 6%, how much is actually my cash value going up? And the amount that it's not going up by is obviously the costs that I'm incurring. And I think when people start examining that, then they start having little aha moments, little discoveries, and then they want to dig deeper and deeper and learn more, especially about something, if you go on LinkedIn, you got one group of people saying whole life is the only thing to buy, and here's why. And then the next post is, here's the IUL is the Swiss Army knife. It's got tax-free this and tax-free that and tax-free this, and dump your 401k plan to buy this product. There's a lot of confusing stuff out there, but when you can boil it down to what are the premiums you're paying, what are the costs you're incurring, are there any undisclosed bonuses that someone's not telling you about, then you begin to have a framework for making decisions and a path to learning.
Yeah, well, I love that, a framework for making decisions, because I think that's something that's really important here, because like you said, as people get so caught up in all these things like, IUL is a Swiss Army knife of financial planning, like you said, be your own banker, tax distributions, but then, you go, well, do you know what the cap is on that policy? And, for listeners, that's the maximum interest rate that can be credited to the policy, or the participation rate, all these levers that the company has full control over, that the policy owner has no control over, that it's kind of like, and then at the end of the day, the big thing to me that people tend to not talk about is this is an insurance policy. And no matter what, you're paying for the cost of insurance. And that can be a significant charge. So it's
right. It's interesting. You mentioned, a couple of minutes ago, the commission and how the commission can affect, or the commission can create pressure, or it can be a conflict of interest. And it's always interesting when one of these commission questions comes up. So a couple of weeks ago, an attorney said to me, hey, my client's thinking of buying this coverage, and he wants to know what the insurance advisor is making on the deal. And I said to him, I'll tell you what I think the insurance advisor is making on the deal, but he's focusing on the wrong number. And he's like, well, what do you mean? I said, well, the commission on the deal is anywhere between, $100,000 and $150,000. But your client's going to be incurring costs of $20 million, right? $20 million. And those costs have a variance of 40% off the mean, meaning someone might charge them 8 million more, and someone might charge them 8 million less. And with the right research, you can figure out where you fall on that $16 million cost spread. So does the 100,000 or 150,000 really matter? Right? Let's pretend I came along and I said, here's one where the internal costs are $14 million, but the commission is $1 million. Isn't that a better deal? Right? With $1 million is saving you, $5 million in costs. So I think that's another thing for people to discover, right? That, people sort of debate, but they're debating the wrong number. It's all the costs you incur, not just what ends up in the insurance person's pocket. It's what's ending up in the insurance company's coffers, right?
Yeah, and what your return is on that. So, let's talk about the independent third-party resources for a minute. You mentioned them briefly. Could you go into a little more detail? What are the independent third-party resources that are available?
Sure. So the first one is a company called Zinnia, Z-I think it's N-I-A, and they just acquired a company that provides information on every insurance company's balance sheet. So they'll tell you what percentage. I think it was called Vital Sales Suite, right? So they're purchased by Zinnia.
Oh, they bought them?
Yeah.
Okay.
Right. So what they do is they'll tell you what percentage of an insurance company's bonds need to be replaced in the next year, the next 5 years, et cetera. What percentage of the bonds are junk bonds? What percentage of the holdings are non-performing real estate? Interesting information about the insurance company's balance sheet, right? And then you can compare two insurance companies versus each other or multiple, just with a click of a couple of buttons. Then there's Morningstar. So just as we know that Morningstar provides research on mutual funds and ETFs, Morningstar also provides very similar research on variable life subaccounts. Is it a growth fund? Is it a value fund, et cetera? Who's the manager? What are the costs? What's been the past performance, right? I think that's helpful. And there's a company called the Ethical Edge, and the Ethical Edge runs Monte Carlo simulations on life insurance. So when the illustration says, Tony, you'll earn 6% a year and your cash value is going to grow from 1 million to 10 million, have you? It looks pretty interesting, but what happens when you vary the rates of return? Because the returns won't be level, the returns are going to go up and down. And it's interesting to see that policy number one, when you vary the rate of return, the success rate remains in the 90s, right? And policy number two, the success rate falls from the seemingly 100% success illustrated to a 90% failure rate where only 10% of people will have a death benefit at age 100, right? So that's another sort of valuable tool. And then there's a company called Veralytic, and Veralytic owns the benchmarks for premiums, cash values, death benefit, costs, et cetera. So those are the sort of the tools in the marketplace, and they're helpful, and a sort of a client can make a decision without pressure. They can make it with data like they make every other decision. Is that helpful?
That's very helpful. And for people watching and listening, is links to all those resources, like always, in the show notes, so you can check them out and learn more about each of those resources. So, Steven, we've talked about this. You and I have been talking about this for years. Some of the other people in our circle, Dick Weber from Ethical Edge, Barry Flagg, who's also with Veralytic. Why are more people not talking about this. That's the thing, is people come up to me, and I'll give a presentation on why life insurance policy, aren't going to work, why this policy is going to have an issue, how policy loans can erode a policy, all these things that you and I have talked about. But there's not a big uproar where you think people would go, oh my gosh, we've got an issue. Why do you think people aren't talking about this stuff?
So I'm going to further your comments with one additional comment, and then we can talk about the potential reasons. But I live in New York, and New York State was the first state to implement a client's best interest regulation, Regulation 187. And agents in the state, not me, sued to overturn the regulation, claiming it was not constitutional. And eventually, the New York State Court of Appeals, the highest court in New York State, constitutionally affirmed Regulation 187. Right, so you can see in that case, the agents were against clients' best interest. But I think if you said to every one of those agents, let's pretend you walked into your doctor's office and the doctor said, hey, just so you know, we no longer work under the Hippocratic Oath of first do no harm, right? Those agents would run for their lives out of that doctor's office, right? So people want clients' best interest. They want the Hippocratic Oath, but they're not getting it, right? So how come? So I think, first of all, let's pretend we're at a career agency shop today, right? So the career agencies, they don't want independent research because their model is you have to sell as much of their product as possible, right? And that's how the mutual fund business was, when our parents wanted to buy mutual funds, right? You call up the AIM fund, and the AIM fund person would show up and sell you the AIM fund. But now that's gone the way of the dodo bird, and now you call up your RIA and they'll say, well, let's gather some facts and hear about your goals, and we'll find what's best for you, right? So I think part of the agency force or brokerage force, they can't use independent research. So that's one of the reasons why it's not changing. And then just like I mentioned, WF, that big bank in New York City, all the ones have the same problem. They've got their list of 5 or 6 companies that pay them the most comp. So if the best thing is the 6th or 7th company, the client's not going to end up with that policy, right? And then some people, have an ego and they want to be the smartest person in the room. I learned 20 years ago, let the research be the smartest person in the room. Then you don't need to go to sales school, and clients love it, and their advisors become addicted to it, just like they're addicted to the fee model, right? I charge them, right? You fee for service, I'll help you obtain the best outcome. There's no sales in that, right? It's conflict free. And so I think those are some of the issues. It has to do with ego, and it has to do with the silo that certain people are in that they can't get out, right? I was at Mass Mutual when I started using this independent research model. I had a letter from FINRA. This method complies with FINRA regulations, and no other methodology has ever received that letter. And the company that I worked for, their initials are MM, they said, you can't use this research here. And I said, what do you mean? FINRA oversees you. And they said, doesn't matter. Your goal is to sell as much MM product as you can, not whatever some research says is the best. I said, okay, that's great. How do I use this? And they said, you can only use it if you quit. And I quit on the spot, right? Because I want my clients to have a better outcome. I want them to have all the data. That's what happens when I go to the store. When I'm going to invest in a mutual fund, I get the Morningstar report. When I'm going to buy a car or a vacuum, I get consumer reports, or I get, I forgot the name of the company, not the Rob report, but there's a report on car reliability. When I bought my wife a diamond ring, I didn't believe the salesperson that the color, the cut, and the clarity was what it was. There was a brochure from the Gemological Institute of America, a nonprofit research company that said, here's the color, here's the cut, here's the clarity, here are the carats. That's exactly what I wanted.
Yeah, no, I love that. And I mean, that shows the value of independent research. And it does beg the question why the life insurance industry has fought it. I mean, you and I both, you just covered it. But that's really, I think, the heart for people watching and listening to the show is just to understand the way the industry is set up is, so let's say you're talking about a big insurance company. If you walk into a Mercedes dealership, they're not going to sell you a Ford. They're going to
Right.
sell you a Mercedes because that's what they have and
Right.
that's what they're selling. And I think, when we think of, not only life insurance, but across the insurance spectrum, or even broader, if you walk into a place that's a dealership, and excuse that reference to cars where you started out much earlier, don't be surprised if that's what they try to sell you because that's what they have to sell you. So I think that's a big part of it.
Right. And when you speak to someone who is in the career agency system or they work for the large wirehouse, they all say they have access to everything, but they don't. Right? That's another sort of dirty little secret. They don't have access to everything, and that's really what hurts the client. On top of the fact that they don't have the data to make the decision on the 6 companies they have anyway.
Yeah, great point. So, Stephen, to start to wrap up, got a couple more questions, but this is probably a big one. Is you talk about this being a new fiduciary era for life insurance. Why is this a new fiduciary era for life insurance?
Sure. So when the CFP board um, came out with the CFP fiduciary standard, it included life insurance as a covered asset. So that was the first time that life insurance and fiduciary were used in the same sentence. And then, sort of tying in independent research, we talk about the Cochrane case, which was the first adjudicated lawsuit regarding a life insurance policy owned by a trust. And if anybody wants a copy of that, we can post it on the links also. So that case, even though the Cochrane family lost $5.5 million, that case was based on going to an independent third party that had no financial stake in the outcome. In that case, it was a fee-only advisor, like you've been speaking about, Tony. And then the New York State definition in Regulation 187 is the care, skill, prudence, and diligence of a prudent person. And those are that's a fiduciary definition, even though it's a client's best interest regulation. Does that make sense why we're calling it the fiduciary era for life insurance?
Yeah, definitely. And I think this is a powerful thing across the board. It's a start, it's glacial, but it is a start, I think, in the right direction. So, to wrap up, what is your number one tip on changing the way we think about life insurance?
I think the number one step, even though this is to call a fee only advisor or get your hands on the research. I think that's if you have it, there was a study and it showed, when you go to a presentation 1 week later, you remember 8% of the presentation, 6 months later, you remember 1%, and a year. If you could remember one thing, call fee only or research. And that's, I think, how you begin going down that glacial path of opening the onion and learning about all of its different layers. I think that's
definitely. Well, Stephen, where can people learn more about you and what you're up to?
So let's sort of close with some like a call to action here. If someone has a question, they can text me at 917-750-6201. It doesn't mean we're doing business together. It just means you have a question. Or you can reach out to Tony, whose contact information will be here. If you want a copy of the Trust and Estates article, we'll give you a link to the article and you can read about the Cochrane case. We'll also post a sample Veralytic report. If your firm has a podcast or there's an estate planning council, we're happy to speak and educate your groups. Just, text me the letter, text me the word, intro. If there's someone in your firm who you think should hear this, we're happy to, have a, private meeting and just, again, walk you through the research. Doesn't mean we're doing business together. Just means you want to learn more and explore. And it's funny, a couple of days ago, I got a call from someone. He said, I saw you speak 10 years ago. It didn't come up until now, right? And so I think it's important, now that everything is on the internet, and this is on the internet forever, those are, hey, reach out to Tony, reach out to Steven, and begin the educational exchange.
Fantastic. Are you available on social media? Are you active on LinkedIn or anywhere else?
Yeah, so I'm pretty active on LinkedIn. I debate a lot of people, who are, saying that, stop putting money into your 401k plan, and this miracle product called IUL, even without a match, will somehow outperform your 401k plan with a match that gets dividends. So I debate a lot of those people. And my last name is, Zeiger. And in case anyone wants to look for my LinkedIn profile, or maybe we can post that in the contact information.
Definitely. We'll post your social media profiles, website profiles, and then, any other information that you want to send me. The article you mentioned about the Cochrane case, those will all be available through the show notes on my website. So, Steven, thanks for joining us today.
Anytime. It was, it's exciting to be interviewed by like a peer, right? So sometimes it's an attorney or an accountant but you live and breathe this. So it's great that your questions can be deeper and deeper and deeper, trying to make this insurance world a better place.
Yeah, well, maybe we need to do a follow-up, maybe get Barry on here. So for people watching and listening, we're referring to Barry Flagg, who's the founder of Veralytic, who has been on the show a couple of times. And Dick Weber is going to be in a podcast episode that will probably be released before this one. So for people watching and listening, Steven mentioned Ethical Edge, which is Dick Weber's company. So you'll also be able to hear from Dick. So thanks again for joining us, Steven. It's been a pleasure.
It's been a pleasure also. And if I had a podcast, I'd invite you to be on it.
Well, I appreciate that. And thank you, everyone, as always, for tuning in to this episode of the Get Ready Money podcast. If you learned something today to change the way you think about money and life insurance, please be sure to subscribe and to tell a friend. Until next time, let's change the way we think about money.